Hi everyone, I'm David Scranton and I'm excited to be here today. Why? Because today's topic is one of the most important topics for those of you over the age of 50 to understand, and that is the difference between individual bonds and bond mutual funds. You guessed it, it's that time again. Time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Welcome to this week's edition of the Income Generation Show. Sometimes people will ask me, what's the big difference between bonds and bond funds? And it really boils down to this. Bonds represent a contract-based investment, whereas bond mutual funds do not. The first comes with two important promises from the issuer, and the second does not. So now you know, and that's our show. So long, and thanks for tuning in today. Just kidding, just kidding. There's obviously much more to it than that. And that's why my main mission for over 20 years now has been educating members of the income generation, just like you, about the many differences between financial tools used by most advisors versus those used by income specialists. Those distinctions become increasingly important as you get closer to retirement. And the fact is, a lot of it deals with this idea of contract versus no contract. Contractual investing is central to the income model and can benefit you in a wide variety of ways once you're nearing retirement, as you'll see later on today's show. But you'll also learn why most advisors don't really want you to know about the difference between bonds and bond funds, and why the two potential guarantees you get with individual bonds are so incredibly important, and how other contract-based income strategies can dramatically improve your odds of achieving your retirement dreams and goals. But before we dive in, I want to welcome back my good friend Jeff Small, president of Arbor Financial Services, a retirement income store in Melbourne, Florida. Jeff is also the author of the Amazon best-selling book, Turning Financial Planning Right Side Up. Jeff, it's great to see you again, man.
Hey, Dave, thanks. Dave, I was thinking, in a lot of ways, you're right. It is all about income. That really is the heart of the matter.
Yeah, absolutely. And investing by contract specifically, because it essentially demonstrates how income can be a true financial strategy, more so than investing for growth or even investing for common stocks, with dividends that can be cut. Because eventually, in some way, shape, or form, all those things have to do with a lot of crossing your fingers and toes and hoping for the best.
So really what you're saying is, if I'm invested in like a bond mutual fund, I'm really crossing my fingers and my toes, because that's kind of the opposite of buying a regular corporate bond.
Yes, that's exactly what I'm saying. And here's how it works. When the average person looking for a conservative investment option, here's the term bond mutual fund, it checks off two boxes in his or her head. One, that person knows that bonds are considered more conservative than stocks. And two, that person knows that generally speaking, mutual funds are a good investment. Unfortunately, what they typically don't know is that a bond mutual fund not only lacks the two contractual guarantees that come with individual bonds, assuming of course there's no defaults, but it also contains a lot of the risks of a stock mutual fund. In fact, if you were to study for your license as a financial advisor, the textbook definition of a bond fund is the stock of a company that owns bonds. So if an advisor tries to tell you that it's a, quote, conservative option, what they really mean is that it represents the conservative end of their aggressive business model. So it's almost as if they specialize in 5-alarm chili, but they're selling you 2-alarm chili because it's the tamest thing on the menu. But to make it worse, they're also telling you it's really tomato soup, when the more conservative option isn't bond mutual funds at all. It's an actively managed portfolio of individual bonds and bond-like instruments. And again, that's because it's a contractual investment. And with that contract are those two important guarantees you don't get with a bond fund. First, a guaranteed dollar amount of interest payment for the life of the bond. And two, repayment of the face amount when the bond matures. Again, both guarantees are assuming there's no defaults. So Jeff, you're right when you say that this topic gets right to the heart of investing for income. But why do you think it is that income specialists like you and me have almost an evangelical sense of urgency about education, about educating people about income versus growth and the different ways of investing about income?
Well, Dave, when you need income in retirement, if you've got two choices and you're getting ready to retire, and one scenario is to get a 2% dividend on growth stocks and pay yourself out $20,000 a year from $1 million of retirement savings, or take $500,000 of that money and get a guaranteed payment stream via like a pension, annuity type scenario where we're getting $40,000 a year of income, which one would they rather choose? They're going to choose the income because they need to have that chronic and consistent level of monthly income to retire properly. Dave, but this brings up another topic. Some of our viewers and listeners might get confused on all of these issues because some of their current holdings are going to be in bond funds. Are bond funds a good way to create income in that kind of a scenario? Are there risks to it?
Technically speaking, bond funds are an income-based investment, sure. But then again, so are high dividend paying common stocks. But high dividend paying common stocks, as we'll talk about later in the show, can cut dividends, so they have more risk. In the same way, bond funds can reduce dividends also. So whereas, yes, technically, they are considered an income-generating alternative, but again, they're a lot riskier than a portfolio of individual bonds and bond-like instruments. But Jeff, if you wouldn't mind, I'd like you to share for a moment with our viewers or listeners, what are some of the other hidden risks or maybe hidden negatives within bond funds that they may not know about?
Yeah, that's a great point, Dave. I think with bond mutual funds, it's not really investing by contract direct. You're buying stock in a company that owns bonds, so you don't necessarily have that first layer of security on the pecking order of what happens when a company becomes insolvent and the chance of getting some money back. But you also have a portfolio of bonds, and if one experiences a gain where they sold off a bond and they experienced a gain, and even though the rest of the portfolio may have lost, you've got to pay tax on that gain, Dave, believe it or not.
Yeah, well, that tax is an extra risk. You're right that most people just don't realize. So I concur.
So when we're talking about risk, Dave, how does risk calculate into the fact that most consumers know that when rates go up, bond prices fall? But how does that affect their individual bonds from a risk perspective?
Well, it really only affects the bonds, as you know, Jeff, if they decide to sell their bonds early. Otherwise, if they hold it to maturity, those two guarantees are still there that said not only will their income not change, but also they'll get their lump sum of principal back at maturity. So again, it's really then is in the investor's control whether or not he or she realizes that loss or not. But I think it's also important to realize, and for me to mention, that interest rates aren't the only thing that affect bond value. Sometimes rates can go up and bond values don't go down, or vice versa. And that's really beyond our conversation today, Jeff. In fact, maybe a good topic for another show to talk about some of the things that can offset that interest rate risk. But quick, before a commercial break, I'd ask Dave a question. So Dave, if I want to break this contract early, what does it do to me? Well, that's a great question, and I kind of just answered it, but it's worth repeating. If you break the contract early, you're going to sell that bond at market value. In the example we just gave, it could be less than par value, it could be a loss, or it could be above par value, it could be at a premium. So when you sell it early, you're literally going out in the market to sell it, and you'll get whatever the market could bear, which most people believe is a little better than, let's say, a CD, where you're going to get a penalty when you sell it early, no matter what. Here, at least, you sell it early, you might have a loss, but you sell it early, you might also have a gain. So thanks for your question. Be sure to submit your own questions to Ask Dave at the link on the screen. And meanwhile, stick around. Right after the commercial break, we're going to have an attorney who's going to talk about the differences between working with a fiduciary versus a non-fiduciary based advisor. Stay with us. We'll be right back here on the Income Generation. I'm David Scranton. During my career, I found that most baby boomers have done a great job growing their retirement savings, yet many don't know how to convert their savings into steady income. And that is why I built the Retirement Income Store, to help hardworking Americans preserve their assets and establish steady streams of income.
If you're 55 or older, our free Retirement Income Kit is for you. It's chock full of information you need to know to get steady income during your retirement. Call 866-710-1749. Online at theretirementincomestore.com.
Welcome back to the Income Generation. I'm David Scranton, and it's great to have you all here because we're talking about the differences between bonds and bond mutual funds. So why is it then that most financial advisors offer bond mutual funds as their income-based option rather than individual bonds and bond-like instruments? And why don't they explain the important differences that we're talking about here today? One reason, I believe, is convenience. You see, once an advisor puts you in a bond mutual fund, he knows that then it's up to the fund manager to do most of the actual heavy lifting. The advisor doesn't even need to really possess or even have access to any of the specialized tools or knowledge that it takes to actively manage a portfolio of individual bonds and bond-like instruments. And if they're a typical advisor with a growth-based business model, then they probably don't have those tools anyway. Another incentive, though, I believe, for the advisor is money. Bond funds are potentially a lot more lucrative for the advisor who's not an income specialist. Why? Well, let's say you go to an advisor who's commission-based and tell them you want to invest $100,000 in a diversified portfolio of individual bonds. What they know, but you may not, is that bonds are typically a one-and-done type of investment. For example, if you buy a 10-year bond, the advisor or broker that sells it to you can only charge you once during the life of the bond. And since the investment isn't considered very speculative, they can't charge you a very high commission on the sale. So while you might think $100,000 is a lot of money on the commission side, and it's certainly nothing to sneeze at, it's typically going to translate to about 0.5% one time for the advisor. Translation, $500. And that's not much cumulative over that 10-year period. But that advisor still wants your $100,000 under their management. So what do? Well, rather than sell you a diversified portfolio of individual bonds and bond-like instruments, chances are they're going to put you into a bond mutual fund. That's a more lucrative option for this person for a couple of reasons. So Jeff, do you mind explaining for a moment what's one of the ways that commission-based advisors, when they offer a bond mutual fund, end up getting really a much better payday than if they did a diversified portfolio of individual bonds for their clients?
Yeah, this kind of mystifies me, Dave, that there's still advisors out there charging upfront commissions and loads on things like bond mutual funds. And what we see very commonly is that commission can be as high as 5%. So if they're charging 5% to get into a bond mutual fund on a $100,000 investment, the consumer is now left, or the investor is left, with about $95,000 working actually in that bond mutual fund. And so that's not good for consumers. But as a fiduciary, Dave, sometimes it gets worse, because when they can put your money under management, other things can happen, can't they?
Yeah, so I get it, right? $5,000 payday is much more than a portfolio of individual bonds where it might only be $500. I mean, it's 10 times as much. But once an advisor has control of the money, if that advisor is more growth-based philosophically, and you know as well as I do, Jeff, most advisors today are more growth-based than income-based, it allows that advisor to start to move some of that money into more growth-based, high-return options, especially during a bull market. But as you said, as a fiduciary, the question becomes, is that really the best thing for somebody that close to retirement? So why is it, in your experience then, do fiduciary-based advisors tend to be more geared toward investing by contract when they go to income strategies versus the stock market?
Well, it's a couple of really plain and simple reasons, Dave. A fiduciary's got to put the client's needs first and take their goals and considerations, make those paramount to make recommendations and give them options on how to get that income and protect their principal. And a bond mutual fund is what we would call the antithesis of being a fiduciary or using upfront commission-based products in that regard. So getting back to the idea, Dave, of investing by contract, what are some of the potential guarantees you get on an individual bond, let's say, as well as do they apply to bonds across the board?
Yeah, and you know, it's interesting. Of course, I know you know the answer. You're asking me for the benefit of our audience. But again, you know, the most important things here are those two guarantees. And some have both, and some have only one. So it's a guaranteed income stream in terms of dollars, whether it's an interest or dividend. And with some instruments, it's actually a guarantee of a return of their principal over time and at some future date. And as we're going to talk about a little bit in the next block, some tools that literally have income guarantees forever. Jeff and I will talk more in just a bit and also answer more of your questions. But right now, let's welcome today's first guest, Anthony Saccaro, a good friend, a perennial friend, I should say, of the income generation, and a good buddy, of course, of mine and Jeff's. Anthony is a lawyer, but we won't hold that against him. And he's also president of Providence Financial, a retirement income store located in LA. He's also host of the Providence Financial radio show. Anthony, it's great to have you back with us here on the Income Generation, as usual.
Thank you. Glad to be here.
So Anthony, you know, it's always good for a consumer to evaluate at least 3 fiduciaries when looking for the right financial advisor. Why is it important for a consumer to work with a fiduciary?
It's actually not just important, it's actually critical. There's 2 different legal standards out there. You've got what's called a suitability standard and a fiduciary standard. The suitability standard means that if there's 10 investments out there and all of them are suitable, then the advisor can recommend the one that pays the most commission. Whereas if you have a fiduciary standard and there's 10 suitable investments, if you must choose the best investment for that client, even if all of them are suitable. So from a legal standpoint, you want to work with someone that must legally have your best interest in mind so that they are 100% acting in your best interest. And if they don't, then you have legal recourse.
That was one of the best explanations ever. So basically the big difference is commission-based salesperson versus an actual professional is what it sounds like to me, Anthony.
Well, that's exactly right. So if you're talking about a suitability standard, a majority of these advisors are getting paid commission from the stuff that they recommend. And again, as long as something is suitable, it could be the worst of these suitable options that pays the highest commission, and they are legally allowed to recommend that to you. And if you sue them, as long as it was suitable, then you lose. But if you're dealing with a fiduciary and you can prove that there was one option better than the option that they recommended and you sue them, then you win. So that's the significant difference. Legally, they have to act in your best interest in a fiduciary capacity, but in a suitability standard, they do not. So very critical to differentiate between the two.
But Anthony, you and I all know people who are fiduciaries but still use bond mutual funds. They're not earning a higher commission like in that previous example. But why would a fiduciary use a bond mutual fund versus a diversified portfolio of individual bonds?
Yeah, that's a great question. In short, the answer is because they are much easier to use. The reality is there's a significant difference between buying individual bonds versus buying bond mutual funds. Most advisors specialize in growth, stock-based investments. So when it comes to income, they don't specialize in that, and so they choose bond mutual funds. And with the bond mutual fund, you lose the 2 most important guarantees that bonds offer you. You don't have a guaranteed interest, and there's no guarantee you're ever going to get your principal back. So they use them because they're easier.
So why do you think most fiduciaries do, even though they're fiduciaries, they do specialize in more growth-oriented, higher-risk options?
Well, generally speaking, the reason is because even as a fiduciary, most fiduciaries started off as a suitability advisor somewhere and then grew into starting their own firm. So it's one of those things that you tend to be like your parents. You tend to be like how you were raised. And most fiduciaries don't start off day one as a fiduciary. They grew up in that environment. Most of the big Wall Street firms are growth oriented, so they stick with what they learned. And that's exactly why.
You know, Anthony, I guess maybe I'm a little more cynical than you, even though you're the one with the law degree. But I think a little bit of it also has to do with the fact that a lot of advisors mistakenly think that if they put you in risky items, more risk-oriented investments, they could justify charging a higher fee and therefore make more money. Anthony, thanks so much for being back with us on the Income Generation. It's been short but sweet. And you stay with us too. Right after the commercial break, we'll be back with another special guest who's going to talk to us about a contract-based investment that actually pays you income for the rest of your life. Stay with us. We have more to come right here on the Income Generation.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow the Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
Welcome back to the Income Generation. I'm David Scranton, and it's great to be here with you all as we talk more about contract-based investments. You see, not all contract-based investments are the same. They carry different conditions and different levels of risk. However, in the universe of income-based financial strategies, all are basically designed to do one thing, and that is to generate income at a fixed rate of interest or dividend, regardless of market conditions. For example, when you purchase an individual bond, your contract is with the business or agency issuing the bond. And while your bond's value will fluctuate on paper due to changes in the market, it has a par value or a face value that doesn't change thanks to you having a contract. And the return of that par value, if you hold the bond to maturity, is part of your contractual agreement, along with the interest paid at a guaranteed amount for the life of the bond. Again, both these guarantees are providing that there's no default. Now, on the other end of the spectrum are common stocks, which really effectively have no par value. So when you invest in common stocks, you're literally just speculating. Also, without a contract, any loss in value while you own the stock might not be recovered, as there's no maturity date, unlike an individual bond where any loss would really just be a temporary paper loss until maturity. Plus, with common stocks, your income isn't guaranteed either, because again, there's no contract. But contractual investing doesn't begin and end with individual bonds. As I said, the universe of income-generating strategies is filled with other contract-based options. One example of those, a controversial example, is an annuity. An annuity is a contract between you and an insurance company that allows you to contribute money to a tax-deferred account, and in return, you can get regular payments as income or withdraw funds later in life, starting at some future date. And that depends on whether your annuity is immediate or deferred. And when it comes to annuities, there are infinite variety of options, but that's a whole other show for another day. So Jeff, here's one for you, because I get this question every once in a while, and I know how I answer it, but I'm curious as to how you answer it. And that is when a prospective client comes to you, is a little bit more sophisticated and says, well, wait a minute, Jeff. I understand that there's a way to actually invest for contract in the stock market. How do you respond to that?
Well, Dave, what they're referring to is a preferred stock. A preferred stock has a fixed dividend and trades at a par value, very similar to how a bond would trade. But people buy them for income because they're considered a cross-pollinated investment between a stock and a bond. And so, Dave, there are other fixed income investments out there, though, besides preferred stocks. And so are some of those more risky than traditional fixed income investments?
Sure. What I think you're referring to is probably things like BDCs, business development companies, and REITs, real estate investment trusts. And those are riskier because a BDC is basically a fund of loans with companies that are really too big to go to the bank to borrow money, but too small to issue bonds on Wall Street. But with a BDC, because you kind of own a fund, it's kind of like a bond mutual fund. There's a niche for it, but again, you don't directly own the contract. There's contracts in the fund that say at some point they've got to pay back all the debt, but you don't own the contract directly. You own the stock of a company that owns bonds. And with real estate investment trusts, it's similar that you own the stock of a company that owns a rental property. So essentially, that way the flow through you get of dividends is really the rental income that comes to you. And again, in rental properties, of course, have leases, hopefully with creditworthy tenants. But again, you own that contract, that lease indirectly through the real estate investment trust. But getting back to bonds, though, you know, we always talk about bonds as if, gee, they're not going to default. You have these two great guarantees. But do you mind sharing in your experience what actually does happen if a bond does default while one of your clients owns it?
Sure. Well, when a bond defaults, at least the client has a chance of maybe getting some of their money back as that company goes through reorganization. But the key is to not buy a bond on a company that's going to be insolvent, because technically a bond is based on, the safety of that bond is based on solvency of that company. Unlike a bond mutual fund where you really have no protection in the event there's a bankruptcy, and at least a bond you have a chance to get a portion back of your money, Dave.
Sure, that's right. You go to bankruptcy court and all the assets of the company get divvied up, and bondholders certainly are way ahead of stockholders in terms of that priority.
So Dave, let's say that I've got a decent amount of money saved for retirement, but I plan on retiring in 5 or 10 years. Is it a good idea to start contract-based investing now, or should I wait?
Well, if it's 5 or 10 years, in most cases, now of course the answer varies with every situation, given goals and risk tolerance and so on. But in most cases, if you're within that 5 or 10 years, I would say yes, that contract-based investing absolutely makes sense for at least some part of your portfolio. In fact, I find that transition really needs to occur somewhere in the range of maybe 10 to 15 years before retirement. Right now, it's time to welcome our next guest, Dee Carter, a longtime friend of the income generation and a real good pal to myself and Jeff also. Dee is president of Carter Financial Group, a retirement income store in Midland, Texas. He's also Amazon best-selling author of the book, It's Now or Never. Dee, now that all y'all have thawed out in Western Texas, thanks for being back with us. It's great to see you.
Yeah, thank you, Dave. We did have a little bit of Connecticut weather down here for a while. It's good to be with you guys.
So Dee, a minute ago, Dave was talking about the good, the bad, and the ugly on annuities. What's good about annuities?
Well, the best thing about annuities is they're always going to be there, Jeff. Once you put your money into an annuity, depending on the company, and obviously we do a lot of research on our companies, that money's going to be there for you down the road, regardless of what happens. It's the bottom floor. It's the basis of what your income planning should be on a guaranteed time basis. So you're going to have guaranteed of your income regardless of what happens, 10 years certain and continuous in most cases. So you know your income is always going to be there. That portion of your income is set up and is fixed for you, and you know you're going to have it.
You know, Dee, people love those guarantees, don't they? Especially on the income side.
They really do. They look forward to that. In fact, when they become to start moving away from performance into purpose-driven type investing, that's the main reason they're going there. Their purpose is to have an income. I have clients tell me every day, the one thing I want to do is like Will Rogers once said, hey, I'm not so concerned about the return on my money as the return of my money. And that's what the good side of the annuity will do for you.
Dave, I don't see much ugly there.
Well, there's a lot of good, but there's a lot of misconceptions also. So Dee, one of the places, as you know, is certain types of annuities have very, very high fees. And I know they're generally not the types of annuities that you favor, but how do you answer that question when somebody comes in and says, but Dee, aren't the fees in annuities as high as 3 or 4%?
In most cases, Dave, what they're talking about there is variable annuities, because every variable annuity is built around mutual funds, if you will, and the mutual fund have fees internally. They're charged to the client. They're taken away from the growth factor and the performance side before you ever see it. So we steer people away from situations where they'll have high fees on the variable annuity type thing. I haven't handled a variable annuity since I left that type of market and moved into income planning over 20 years ago.
Yeah, and the other problem with variable annuities, too, is they're really the one type of annuity where, although your income's guaranteed, your principal's at risk. So that seems like a double negative, high fees and your principal at risk. And that's not what most retirees and people approaching retirement want, right?
That's exactly correct. They don't need to have the high fees taken away from their income. So we try to direct them into things that have par values, things that are guaranteed, so they'll get away from the risk side of the factor. I don't want my clients to wake up one morning and find out they don't have any income. That's like going to school one day and coming home and finding out your parents have moved. That's not a comfortable feeling.
Yeah, well, it's good to hear, because I know you guys are a little bit tougher in Texas than most of us in the rest of the country, but it's good to see that the sentiment of people is very much the same when it comes to investing for income. So Dee, thanks so much once again for being back with us here. We really appreciate it.
Hey, I appreciate the opportunity. You guys have a great day.
And you stay with us too, because right after the commercial break, we're going to be talking about how you can invest for income even if you want to stay in the stock market and have more upside potential. So stay with us. We'll be right back here on The Income Generation. I'm David Scranton. When it came time for my mom to retire, one simple mistake forced her to work years longer than she should have. And that's why I started the Retirement Income Store, to help hardworking Americans 55 and over plan for the retirement they deserve. I couldn't help my mom, but maybe I can help you.
If you're 55 or older, please claim our free Retirement Income Kit. Chock full of information you need to know to get steady income during your retirement. Call 866-314-7227. Online at theretirementincomestore.com.
Welcome back to The Income Generation. I'm David Scranton, and it's great to be here with you all to talk about the differences between the right versus the wrong financial strategies for those of you at or near retirement. In other words, those of you who are part of the income generation. In my 30 plus years of experience as a financial advisor and a financial educator, the conservative options and the moderate options, those on the left and the middle of this chart, tend to be the right options for a majority of your money. And by that, I mean that they're typically the most practical and appropriate options for people in or nearing retirement. Why? Because they all have one important thing in common. They're all contract-based investments, to some extent at least. They're all designed in some way to generate income at a fixed rate of interest or dividend, regardless of market conditions. And they're the kind of options that allow an income specialist to help you build a true financial strategy that's aligned with your income-based retirement goals. A strategy based much more on factors that you know than on factors you have to cross your fingers and toes hoping for. And for a lot of people, shifting to a completely conservative to moderate portfolio of income-based strategies is the right call. And it can be done with the help of the right income specialist. However, as I mentioned earlier, it isn't necessarily the right call for everyone. You might have a slightly higher risk tolerance level, in which case the portfolio built entirely around contract-based investments and bond-like instruments might not be right for you. You might prefer to continue using some more aggressive stock market-based strategies, common stocks and stock mutual funds, even after you've shifted your focus from growth to income. But guess what? That can be done too. But the key word there is to do it strategically. For example, let's say that you want to stay in some common stocks in spite of the absence of a contract. Well, that's fine. But be aware that a skillfully managed portfolio of high dividend yielding stocks can be much more effective as a way to go after age 50 than continuing to invest in stocks for growth or capital gains. In fact, there are many potential advantages to that type of strategy, this dividend-based strategy for certain investors in or nearing retirement. But beware, despite a popular misconception, investing for dividends in the stock market is actually much more challenging than investing in growth or momentum-based strategies. As a matter of fact, we're to talk much more about that misconception on an upcoming episode of The Income Generation, so you're not going to want to miss that. So Jeff, I'm just curious, what percentage of your own clients would you say rely exclusively on contract-based strategies? In other words, those things that are on the conservative or moderate side, versus those that actually have some money in higher dividend common stock strategies?
Well, Dave, about 50% of them do because they need to generate that income from fixed income investments so they can augment that to their lifestyle and have the retirement income that they desire. So Dave, how often do you review your clients' income needs and goals?
Well, yeah, I mean, we obviously need to review on a regular basis, but I believe the general rule is the more aggressive a portfolio, the more often it needs to be reviewed. And the more conservative a portfolio does not have to be reviewed as much. So we have some people that we only really feel the need to review maybe once a year. And then we have some people that we review every quarter. Of course, if somebody needs a review between that and they come to us, you know, that's fine. We review people whenever they ask us to, but that's the general rule. So this 50% of your clients that now has some money in common stock strategies. I know for us that's grown more recently after COVID when the market seems to be taking off. Are you seeing that growing more rapidly recently in your clientele also, the interest in the high dividend common stock strategies to augment the contract-based stuff?
We really are, Dave. And now it's very common to see a 20 to 30% weighting in high dividend common based stocks or high dividend value stocks that have the potential for appreciation, but also give us that high dividend. So yeah, it's very common to see that with about 20 to 30% of a portfolio weighting for those clients.
Mm-hmm. Yeah. And I think for you, our loyal viewers and listeners, I think the most important thing to understand here is that, there's some part of your income you probably want to have contract-based interest and dividends. Why? Because you need a minimum amount of money just to get by. But then there's a part of your income goal that is for all the nice to have things, not the need to have, the nice to have. And if you're of the right risk tolerance level and you want to fund some of those nice to have things with dividends from common stock strategies, and if your risk tolerance is proper for it, it can certainly work. Now it's time to welcome our last guest, Michael Stewart, founder of Crystal Lake Tax and Financial, a retirement income store located just outside Chicago. Michael's also the co-author of the book, Purpose-Based Investing, as well as host of the Retirement Success Blueprint podcast. Michael, thanks so much for being here with us today.
Appreciate you having me on, guys.
So Michael, why is value investing more difficult than growth investing?
Yeah, the biggest challenge, when you look at growth investing, it's really more about momentum and trying to pick the next winners and what's working in the market or not. That's really just more timing. When you talk about value investing or investing for good dividend income paying stocks, you have to be careful that are they a value for a reason? Are they down because basically they're just not good businesses right now with what's going on in the world? Or are they down for the wrong reasons? And then instead of being a value trap, they actually present a lot of value, not only for good solid income from dividends, but some potential future capital appreciation as well.
So you're trying to say I just can't go out and buy AT&T and ExxonMobil and all these high dividend payers and sit back and hold them because they're big stable companies that have been around forever?
Yeah, I think if you look at the charts on a lot of those, there's a reason why their dividends are so high. So if you look at some that are out there, we talk with clients all the time that, stock may be paying a 7, 8, 10% dividend, but it's because their share price has been cut in half. That's why it's now paying a good dividend. So you want to check out the balance sheet. You want to do some due diligence, some analysis to make sure that if it's down, is there not a good reason why it's down? So it presents a good opportunity, not only for current income, but future growth as well.
So I guess what you're trying to say is in some ways it might be better serving people to not try this at home.
Mm-hmm. Oh, absolutely. It's not for the faint of heart. It's kind of a double-edged sword there, so you have to be very careful. But for the right opportunities, it can be a tremendous value to your portfolio.
Michael, as usual, it's been great having you. You're a great friend of the income generation, as well as a good friend of mine and Jeff's. Michael, thanks so much for being with us today on the show.
I appreciate you having me on again. Thanks, guys.
As almost everyone knows, no investment or financial strategy is completely risk-free. However, understanding the differences between contractual and non-contractual investment strategies can certainly help minimize a lot of the risk at a time in your life when it's extremely important to do so. So please remember that bonds and bond mutual funds are two very different things. The first represents a contractual investment that comes with two important guarantees, assuming, of course, no defaults. And the second not only lacks those guarantees altogether, but it carries a decent amount of the potential risks of a stock mutual fund. Also, please think back to why most advisors don't tell you that. Remember that the universe of income-generating financial strategies is filled with a variety of contract-based options, all designed to reliably generate the income you need to achieve your retirement dreams and goals, regardless of market conditions. Thanks so much for joining me here today on The Income Generation, and thanks to Jeff Small and all of our guest advisors. We've had a blast. And remember, it's all about the income, and we'll see you next week.